Welcome back to the Capital Breakdown. Today, we're tackling a question that keeps popping up in investing circles. Between traditional index funds and modern ETFs, which one actually comes out on top? You may have heard that simple index funds are the gold standard, but ETFs have been gaining major ground with their flexibility and innovation. By the end of this episode, you'll understand the real differences between these two investment vehicles, how they perform, and which might fit your financial mindset better. No hype, just clear, practical education to help you feel confident navigating your options. Here's where most people get tangled. They see index funds and ETFs as completely different beasts, or think one automatically means better returns. But in reality, many confuse what these tools really are and how they behave. Imagine you're shopping for groceries. You might think buying a pre-made meal versus fresh ingredients means one is always cheaper or healthier. But it often depends on what you want, how you use it, and your lifestyle. Similarly, investors often pick between index funds and ETFs without knowing how fees, trading, and tax implications could influence their experience. Understanding these nuances can save you from surprises down the road. So let's break it down. What exactly are index funds and ETFs? Think of both as baskets holding a mix of stocks or bonds designed to track a market index, like the S&P 500. An index fund is like a big jug of fruit punch. You put money in, and the fund manager pours your share of the mix, usually priced once a day. ETFs or exchange-traded funds are more like fruit baskets sold at a market stall. You can buy or sell shares throughout the day, with prices changing moment to moment. Both aim to match the performance of the underlying index, but their packaging and trading mechanics differ, giving each unique perks. To add a little more color, picture the index fund as a calm river flowing steadily. You invest, and the fund's value changes once daily based on the market's close. ETFs, on the other hand, are like speedboats zipping around in that river. You can jump on or off at any time during market hours, and the price you pay can fluctuate slightly from the fund's net asset value. Both rely on fund managers who replicate the index by owning the same stocks or bonds in similar proportions. The key takeaway: they're both tools to own a diversified slice of the market, but the way you interact with them can vary. Now, let's peek behind the curtain at how these vehicles operate. When you invest in an index fund, your money goes directly into the fund company, which pools it with other investors' cash to buy the underlying assets. The fund's price updates once a day, reflecting the value of those assets. ETFs, however, are traded on stock exchanges, so investors buy shares from other investors, not directly from the fund. Here, authorized participants, usually large financial institutions, play a crucial role by creating or redeeming ETF shares to keep the price close to the actual value of the assets inside. Fund providers, brokers, regulators, they all work together to keep things running smoothly, but each step adds layers where fees or small price differences can show up. Fees are a big piece of the puzzle. Both index funds and ETFs generally charge low management fees compared to actively managed funds, but ETFs often come with trading costs, like commissions or bid-ask spreads, especially if you trade frequently. Index funds might have minimum investment amounts, but don't require you to time the market, since you buy or sell at the day's closing price. Brokers who facilitate ETF trades may add small fees too. These details might seem minor, but over years they can impact your returns. That's why understanding the flow of money and costs behind the scenes is key to making a smart choice. Let's walk through a couple of examples to bring this to life. Imagine Sarah, who contributes a fixed amount monthly into a broad index fund that tracks the overall stock market. Her purchases happen once per day at the closing price, making it simple and consistent. Over time, she benefits from dollar cost averaging and low fees, with little need to monitor daily price swings. Now picture Jake, who uses Etfs to make more active trades, buying and selling shares throughout the day to capitalize on short-term market moves. While Jake enjoys flexibility, he must watch out for trading costs and the emotional roller coaster of real-time price changes. Both approaches have their place, but they serve different investing styles. What about risk? Both index funds and ETFs carry market risk, the chance the overall market goes down. And that's unavoidable. But some traps can sneak in depending on how you use these tools. If you chase single stocks or sector-specific ETFs, you might face higher volatility or concentration risk. Leveraged ETFs, which multiply exposure using borrowing or derivatives, come with amplified risk and aren't generally suited for long-term buy and hold strategies. Patience and realistic expectations are your best allies here. Remember, investing isn't about quick wins but steady growth over time, with risks managed carefully. Common mistakes include jumping into ETFs just because they're trendy, without understanding the costs or implications of frequent trading. Others might overlook the minimum investment requirements of index funds, or get frustrated by the lack of intraday trading. Some investors don't consider tax efficiency differences. ETFs often have an edge here due to how shares are created and redeemed, which can reduce capital gains distributions. But these advantages can be minor if you're investing through tax-advantaged accounts. The point is, the best choice depends on your personal financial goals, time horizon, and comfort with market ups and downs. So how do you think about these tools in the grand scheme of your finances? Start with a solid foundation, budgeting well, building an emergency fund, and paying down high-interest debt. Once those are in place, investing, whether through index funds or ETFs, can help grow your savings toward long-term goals like retirement or major purchases. The key principle is diversification and aligning your investments with your risk, tolerance, and timeline. Both index funds and ETFs can be powerful building blocks, but they're just parts of a balanced financial plan, not magic bullets. It's worth emphasizing that neither index funds nor ETFs guarantee profits or protect against losses. Markets fluctuate, and your investments will too. That's why understanding your personal risk tolerance and investment horizon is crucial before layering these tools into your portfolio. Regularly reviewing your strategy, staying informed, and avoiding emotional reactions to market noise can set you up for smoother progress. The Capital Breakdown encourages you to embrace education as your best investment. Knowledge helps you navigate uncertainty with confidence. Before we wrap, remember this is purely educational content designed to help you understand the basics of index funds and ETFs. It's not personalized financial advice. Everyone's situation is unique, so it's important to do your own research and consider consulting a qualified financial professional before making investment decisions. The more you learn, the more control you have over your financial future. To recap, both index funds and ETFs are great ways to capture broad market exposure with low costs. Index funds offer simplicity and steady pricing, while ETFs provide flexibility and intraday trading. Understanding how they work, the fees involved, and the risks can help you decide which aligns better with your investing style and goals. Thanks for diving into this episode of the Capital Breakdown with me. Keep asking smart questions, keep learning, and keep building your financial confidence. See you next time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.